You may have heard that inheritance isn't significant for most people, but it is a major factor contributing to wealth disparities in America. Subject: family wealth disparities and inheritance. Passage to fact check. Think about this: when someone dies, their assets get passed down to heirs. For many families, that can mean a significant difference between getting a financial head start or struggling to keep up financially. Let's break it down with some numbers and examples. Imagine you have two neighbors. Neighbor A has diligently saved and invested, accumulating $1 million by retirement age. They leave this inheritance to their children. In contrast, neighbor B has not accumulated any savings or investments and leaves nothing behind for their next generation. The immediate financial gap between these families is stark, highlighting one of the key contributors to wealth disparity in our country. But here's a myth buster: inheritance isn't just about rich people passing down millions. Even modest inheritances can make a significant impact on your financial future. Let's take an average family with $100,000 saved by retirement age. If that money gets passed to the next generation and is invested at an annual return of around 7%, it can grow into hundreds of thousands more over several decades due to compound interest. So how does inheritance really work? When someone dies, their assets are distributed among heirs based on the terms of a will or according to state laws if no will exists. Inheritance can be seen as receiving an unexpected financial asset, though it often comes with significant tax implications and legal requirements that must be addressed. Now here's the hidden math. Let's say you inherit $10,000 at age 25. If you invest it in a low-cost index fund earning an average of 7% annually compounded, that initial amount can grow to over $38,000 by the time you're 65. That's just from one small inheritance. But here's where things get tricky. Taxes can significantly reduce your inheritance. Estate and gift taxes may decrease the amount you receive. In many cases, what starts as a substantial sum might end up being considerably smaller after taxes are paid. So that initial $100,000 inherited could easily be reduced to around $75,000 or less, depending on various factors including tax laws and the size of the estate. Another myth is that only rich people get inheritances. But the reality is that modest savings and assets can make a significant difference for middle-class families too. For example, consider a family with $50,000 saved by retirement age. If passed down to their children who then invest it at an average annual return of 7%, compounded annually over approximately 4 decades until they reach 65, the inheritance could grow to around $342,000. But here's the counterintuitive truth: many families who inherit small amounts never invest them wisely. They might spend it on an emergency or luxury item instead of saving and growing it. So while inheriting $10,000 sounds like good fortune, if you don't reinvest it at a reasonable rate of return, it won't grow significantly over time. Now let's look at the broader picture. Wealth inequality isn't just about who has more money now. It's also about who had an advantage from day one due to inherited assets. For instance, studies show that individuals receiving even a small inheritance are much more likely to own their homes and avoid debt compared to peers without any inheritances. But here's where history repeats itself. The Great Depression taught us that relying solely on current income isn't always sufficient. Families with savings and inheritances were generally better positioned to endure economic downturns, while those lacking such resources often faced greater difficulties. And speaking of storms, remember 2008. The financial crisis that year hit hard. However, for many families with inherited assets, it was less devastating. These inherited funds often served as a safety net, enabling those families to weather the economic downturn and recover more effectively afterward. So here's another myth. People assume wealth is all about smart investments or high-paying jobs. While these factors can certainly contribute, they are not the entire picture. Inheritance plays a significant role in creating generational stability and financial security. But there's also a dark side to inheritance. It can deepen existing wealth disparities. Wealthy families can pass down significant assets, while others may struggle with debt or lack of savings. This perpetuates cycles of inequality and limits opportunities for less advantaged families to improve their financial situations. Now let's dive into some history. The Gilded Age, which occurred from approximately 1870 to 1900, saw massive wealth disparities due to industrialization and unchecked capitalism. The rich accumulated vast fortunes through business ventures and investments, often passing these down through generations via inheritance, thereby creating a rigid class system that's still felt today in many ways. But here's where things get interesting. Even modest inheritances can help close gaps between middle-class families. For example, if one family inherits $50,000 to invest and another doesn't, assuming an average annual return of 7%, the first family could end up with a net worth nearly 4 times higher over 30 years due to the power of compound interest. So why is this important? Because understanding inheritance means recognizing how wealth inequality isn't just about earning power. It also involves inherited advantages. Being born into a family with some financial resources improves your chances of securing a stable future compared to starting from scratch each generation. But here's the kicker: while inheritances can help, they do not guarantee success. Effective money management and smart investing remain crucial. Therefore, even when receiving an inheritance, utilizing it wisely is key to building long-term wealth. Now let's talk about risk. Inheriting large sums comes with its own set of challenges. High tax liabilities, managing new assets, and potential family disputes can all cause stress and financial setbacks if not handled properly. It's like receiving a big gift, but having to deal with the complications that come with it as well. So here's what you need to know. Inheritance isn't just about receiving money. It's also about understanding its potential impact on your financial security and your family's legacy. For many, it can significantly alter their future opportunities and stability. But let's not forget the hidden costs, fees and taxes that can eat away at inheritances before they even reach beneficiaries. These factors often quietly reduce potential wealth transfers over time, leaving less for future generations. Now think about this: if inheritance could make such a big difference, why do so many families still struggle? Part of the answer lies in generational poverty cycles, where parents without financial resources cannot pass anything on to their children. Breaking these cycles requires more than just inheriting money. It necessitates systemic changes like improved education and robust social safety nets. But here's another perspective: inheritance can also be a powerful tool for building wealth. Those who receive even modest sums have the opportunity to grow their inheritances over decades through wise investment decisions. The key is understanding how to leverage that initial gift into long-term growth by investing in assets like stocks, bonds, or real estate. So let's recap. Inheritance isn't just about who has more money now. It's about who had an advantage from day one. Even modest inheritances can significantly impact financial outcomes, but only if managed effectively. And for those without inherited assets, the challenge of building wealth from scratch is considerably greater. Now here's the sobering truth that dispels the glamorous myth. While inheritance can seem like an effortless windfall, it often involves intricate legal issues and financial challenges. The true value lies in understanding how to utilize these assets effectively. Finally, let's remember why this matters. Understanding inheritance helps you see wealth inequality from a different perspective. It reveals a hidden layer in why some families accumulate significant wealth over generations, while others do not. So whether you're planning your own financial legacy or hoping to benefit from one, knowing the mechanics and impacts of inheritance is crucial for comprehending broader economic disparities. This is educational and historical, not financial advice. Inheritance isn't just about receiving money. It's also about navigating a maze of paperwork, taxes, and legal issues. The process can be overwhelming, especially if you're not familiar with estate planning or tax laws. For instance, the federal estate tax exemption for 2023 is $12.92 million, but many states have their own inheritance and estate taxes that kick in at much lower thresholds. Moreover, large inheritances often come with strings attached. Beneficiaries might face restrictions on how they can use or invest the money. Some families establish trusts to protect assets from creditors, or ensure that funds are used for specific purposes like education or healthcare. Understanding these conditions is crucial to avoid legal pitfalls and potential disputes. For those without inherited wealth, starting from scratch means facing a tougher path. Building wealth requires discipline, patience, and often access to opportunities that are not equally distributed across all segments of society. Take homeownership as an example. Families who inherit homes can benefit from property appreciation and may have lower barriers to entry compared to first-time buyers, who frequently struggle with rising home prices and limited savings. Another critical point is the role of networks and mentorship in financial success. Individuals born into wealthy families often have a built-in support system of advisors, family friends, and experienced relatives who offer guidance on investments, tax planning, and other financial strategies. This network effect can significantly impact long-term financial health by providing access to information and resources that may be otherwise difficult to obtain. Learning about inheritance provides insight into intergenerational wealth transfer. Successful business owners or entrepreneurs often pass down not just monetary assets, but also their businesses to the next generation. These inheritors frequently have a head start due to inherited knowledge, connections, and resources, which can give them an advantage over those starting from scratch. Understanding these dynamics is crucial for anyone seeking to understand family wealth disparities. Whether you are planning your own financial legacy or aiming to build wealth independently, understanding how inheritance works can help you make informed decisions and navigate these issues with confidence. This is educational and historical, not financial advice. Intergenerational wealth transfer isn't just about money, it's also about values and education. Children born into wealthy families often receive financial literacy from a young age, learning about investing, saving, and managing risk long before their peers even open a bank account. This early education can significantly influence their ability to build wealth over time. For example, consider two siblings. One inherits $1 million at 25 while the other starts with zero. With proper investment advice, the inheritor could potentially grow their inheritance significantly over time through compound interest and smart financial decisions. Meanwhile, the sibling starting from scratch would need to work harder and longer to accumulate similar wealth, highlighting how early access to capital can dramatically affect long-term financial outcomes. This isn't to say that everyone who receives an inheritance mismanages their fortune or fails in life. Many individuals wisely use inherited wealth to support causes they care about or help others start businesses. However, for those lacking such advantages, it can feel like an insurmountable hurdle. One way to bridge this gap is through public policies that encourage equal opportunities and financial education for all. Programs like universal savings accounts established at birth could help every child begin building their own wealth early on. It's about leveling the playing field so everyone has a fair chance, regardless of their background. This is educational and historical, not financial advice.